Hello everyone and welcome to this latest review of the week in markets. I'm delighted to be joined by Faye Graham, our investment analyst within True Potential Investments and also an income specialist for the income focused portfolios. So we've only got good news to report on. For those of you who have been following us over the last 3 months, you'll be aware that many of our updates have been dominated by the events emanating from the White House, particularly with regards to global tariff and trade policy. Well, we now appear to be nearing the end of that process, and it's only good news to share with you. We're at all-time highs in equity markets across the UK, the US, and now Japan. And we're also likely to see the same in Europe soon, given the positive backdrop. So, over to Faye. What is driving this euphoria in particular this week?
Yeah, exactly. As you mentioned, all-time highs in US, UK, Japan, potentially to see the all-time highs in Europe as well. So in the US, well more than recovered from the initial Liberation Day drawdown now. We've had obviously optimism over new trade agreements. So we've had the US-Japan trade deal this week, which has boosted the Japanese equity market as well as the US as well. And we've got potentially more trade agreements to come as well before the August 1st deadline, which is also supporting markets. We've got a potential trade deal for Europe and the US to come as well.
Okay, so if we go back, the UK was probably first in the queue, got a deal done with the US at around about a 10% average tariff rate.
Yeah.
The market's base case for global tariffs back in April was around about 20%. Obviously, the initial Liberation Day announcement was much greater than that, and that's what caused markets to sell off. But for instance, on the Japan deal, which is hot off the press, what's the detail on the tariffs there, which markets are taking so well?
Yeah, so the deal basically, the US will impose a 15% tariff on all Japanese goods imported into the US. That's down from the 25% that Trump had threatened. So markets are taking that very well. And importantly as well, that 15% actually includes autos, which was quite a big sticking point for Japan in the trade negotiations. They were previously subject to 27.5% levies. And it's quite an important sector for Japan, makes up about just over a quarter of its exports to the US. So quite a really big win for Japan there. And you've seen shares in Japanese auto manufacturers really rally following that announcement. So things like Toyota, Honda up 10-15% following that news. In return for that, Japan's agreed to invest, I think it was $550 billion into the US.
A large number.
Yeah, a large number. That's really focusing on key sectors like infrastructure, semiconductors, pharma, and the US will take the bulk of any profits from that. So it's a bit of sort of give and take.
Okay, so it sounds like President Trump gets to have his cake and eat it again. Now, with regards to, we were surprised yesterday by the very rapid follow-up with the potential EU trade deal. That was always perhaps seen as the most difficult to get across the line because the EU is obviously a multitude of sovereign states and the UK knows of the problems with that. What details do we know, if any, on the proposed deal with the EU?
Yeah, so they're quite close as well, as you mentioned, to reaching a deal with the US. It seems kind of similar to the Japanese trade deal, so they're sort of looking at 15% tariffs as well on European imports, and that should also include autos as well, so similar to the Japan deal. If we think about the tariffs that they currently face, they're facing threats of about 30%, so that would be, again, a big win for Europe.
Okay, so if we wind back to the clock to Christmas time where none of these tariffs were actually in place, we appear to be roughly now have a 10 to 15% tariff imposed on all of the major economic regions by President Trump. I think it's a perfectly reasonable question. Why then are we seeing all-time highs in equity markets? There must be something else driving this euphoria within stock markets. So for colour, what is it we think that's underpinning equity strength?
Yeah, there's a number of factors that are driving that. So underlying earnings expectations are really strong. You've got strong nominal GDP, fiscal deficits supporting the economy as well as expected tax cuts. So if we dive into maybe earnings are actually expected to be a little bit lower for 2025, but the market's really looking through that, and 2026 earnings are still expected to be really strong. So as I said, a number of factors driving that, like tax cuts. That should really support
And we should
earnings.
say equity markets are always forward-looking and will always look through bad news if there's better news ahead.
Exactly.
And that we now think equity markets are more focused probably on the 2026 earnings outlook, not just for the US, but for global economy as well.
Exactly, yeah.
Okay, so that's a really strong backdrop. We're in this unusual period of an economic cycle where fiscal deficits remain quite high and no government is really credible about reducing spending. It's not just a problem in the UK, but the US has pledged to maintain its spending, and we know that France has similar challenges. Japan wants to do some stimulus with its fiscal levers, and Germany is committed to doing that. So let's focus it then on the true potential portfolios. Which of our managers do we think stands to benefit the most from the recent bounce in equities?
Yeah, so it should really be good for some of our managers that have been positioning for that positive economic backdrop. So, managers with higher equity weights that are leaning into those more cyclical areas. So I'd maybe bring out Trinity Bridge, or formerly called Close Brothers. They've been building up their equity exposure now towards sort of the highest levels that they've held for quite a while. And they've also been rotating into those cyclical companies, so companies that are more exposed to the business cycle and should tend to do well when the economy is doing well. So they should perform quite well. Also, managers like Growth Aligned as well. Our in-house fund managers should benefit from that as well.
Good. So really the managers who've been constructive for most of the year and have expressed that through a larger allocation to equities are those benefiting. So that's great to hear, and that should come through in the portfolio valuation soon. So that's all for this week. It's been another strong week for equity markets, as Faye has neatly described there. Much of the noise which has dominated markets over the last 3 months with regards to tariffs and trade is disappearing fast, and so the market can now focus again on the growth outlook, which it appears to be doing. And of course, some additional good news: the UK and India appear ready to now formally sign the trade deal that they have recently agreed. So it's just a positive story to leave you with. Please enjoy your weekend, and please do like and subscribe on the YouTube channel. That's all for this week. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.